Here, let's talk first about competitors today. We're going to talk about just the market situation. We'll talk about inputs. We'll talk about prices of hogs. But obviously there are a lot of factors affecting what we're doing. One of them is chicken. This is the current market shares, or at least before the bankruptcy of Pilgrim's Pride, of the top the chicken manufacturers in the United States. There's Pilgrim's was number 1, Tyson was number 2, Purdue is number 3, Sanders and Farms is 4th, and you can see on around this, Pilgrim's had about a 24% market share. That market share is not going to go away. Part of it will go to some other owners, and part of it will stay with a reorganized and probably smaller Pilgrim's company. But still, it is a sign of the difficulties in the meat business when Pilgrim's, which was leveraged to the eyeballs, has that much trouble, and now Tyson has had enough trouble that Dick Bond is out, and they brought Leland Tollett, a former CEO, back in. I've always understood that Leland Tollett forgot more about the chicken business than everybody else knew, and that's the specific reason that they brought a chicken guy back in to run Tyson, is what's going on in that business. It's going to be important to us. 08 broiler slaughter, if you take an equal number of weeks for the 08 data versus the 07, it was down 0.7%. We economists have a little trouble. About once every 5 years we have an extra week that we have to deal with, and this is the year. When we have a Saturday on the 3rd of January, there's an odd week, so some of these slides may look a little goofy, and if you look at our year versus year comparisons in North American Preview and the data that we provide, you'll see some very strange numbers there right now because we're comparing odd weeks. And even if we use daily data right now, it's messy because a year ago, the first week of the year had 3 slaughter days in one Saturday, and this year only had 1 slaughter day in one Saturday. So early in the year, these year-to-date numbers look very strange right now. So give us a little time and they'll start evening out. But broiler slaughter down last year. That's kind of a monumental thing. If we took equal number of days, it was almost dead even with a year ago. On an equal number of weeks, fourth quarter was down 5.8%. A huge drop in the fourth quarter on broiler slaughter. They made up with some of that with higher weights, but still production was down 1.2%. Production was up 1.2% for the year, still down. If we look here in the fourth quarter, down about 4% on broiler production. The huge cutbacks are still on the way. Egg sets have been down dramatically since the fourth quarter. You can see there, fourth quarter of last year, down 2.9% for the year, almost 8% for the fourth quarter, and they've been down over 6% so far this year. So we have a lot fewer chickens that are going to be hatched and placed at some point here. They've pushed up these prices. You can see these are 12-city wholesale broiler prices that have been over $80 all the way since November. Now, if we do a year-over-year comparison, really all that means is that prices a year ago were just really awful. And this price is good, but still not high enough to cover their increased cost. So the broiler industry is fighting to try to push prices up and get these costs covered. Longer-term reductions are in the offing. This is the broiler hatching flock. And you can see a very definite seasonal pattern. It goes down in the fall, usually bottoms out in November, December. But boy, last year's reduction was a large one. The largest on record from May through November, and the lowest December 1st, at 52.405 million laying hens, was the lowest since September of 97. It recovered just a bit in January on the January 1 inventory, but that's still the lowest January 1 inventory since January of 1998. So this business is hurting as well. If we look at cattle on feed, last year from May onward we ran lower numbers of cattle in feedlots. Pardon me, from June onward we ran lower numbers of cattle in feedlots. Not a real surprise on that. December was down 6%. January 1st, cattle on feed was down 7% from a year ago. And so we look at these numbers and we say, well, gee, we ought to have less beef coming. Well, that's true, but there's this one little problem. And hopefully we'll get this rectified with the publication of the cattle inventory report tomorrow. This is the July data for the number of bulls, steers, and non-replacement heifers over 500 pounds that were on farms. And if you look here at the red bars, that last year was almost exactly the same as the year before. It was down 0.5%, which is what the blue number reads here on the right. Okay? If the supply of 500-pound and over animals on July 1 is down 0.5%, and we've been placing 5 and 6 and 7% fewer animals the entire second half of 2007, then the question is, where are the others? Have that many of them died? Well, probably not. Are they still on grass waiting to come to town? Boy, that's kind of a chilling thought if you're looking at a meat market that's having some trouble with prices. So it's going to be interesting what tomorrow's cattle inventory report says. One option is that USDA may go back and revise all those numbers and say, oh, we missed it. There just weren't that many out there in the beginning. I would say that's a pretty good possibility. Okay? Because it really doesn't add up right now, and we're not hearing about a lot of animals backing up, but the numbers just do not add up on this present time. The expectations for the report tomorrow are that all cattle and calves will be down, that the beef cow herd will be down. Beef cows and heifers that have calved will be down about over 1%, which is a pretty big move there. I think it could be actually a little larger than that. Heifers, beef cow replacements down 2.3%. That's a smaller reduction than what we saw back in the summertime. And then some reductions in the amount of cattle that are going to be coming to feed yards in the coming year. So the beef business is in the process of turning around and cutting back, but it is an aircraft carrier. You just don't turn it very fast quickly, and so it's going to be 2010 and beyond before we see really any impacts on supplies. What happens when you delay placements? Cattle get big, and placement weights have been up the entire second half of this year. And what does that mean about cattle coming out of feedlots? They're big too, and so we're going to see carcass weights go up at a time when already feedlots are having trouble keeping their money together. Some of the losses have just been pretty astounding on these feedlot cattle in the last 2 or 3 months. $200 a head on a good number of the cattle sold. Longer term, fewer beef cows. We had a big run up in cow slaughter last year. Part of that was because we brought Canadian cows into slaughter again starting in November of 2007. But still, even if you adjust for that, U.S. beef cow slaughter was much higher in 2008, and again, I think will probably drive that cow herd number in the cattle report down even more than what we expect, maybe about 2%. So our competitors are in the process of cutting back. The impact of the chicken cutbacks will be quick. The impact of the beef cutbacks, of course, will be much slower. That's good for us. Don't know if it'll help us fast enough. Okay, let's look at feed prices. Corn and oil prices had started to move very closely together back in 2006, and we see that they did this run up here and come back down. And I've had some people say, well, is that just because the same speculators were in both markets? Well, yeah, maybe some of that. But there was also a direct demand tie between oil prices and gasoline and ethanol and corn. When those other products went up, corn values went up to be used for that, and so this reflected it. There was some scare factor last summer in both the oil and the corn markets until we got to about July. But notice in recent weeks, really since November, corn has kept going down, corn has stopped going down, and oil has kept falling. And there's been a definite separation of these, at least in the short run. Now, that kind of flies in the face of the oil is setting the price of corn argument, but it also says that there are other uses of corn, and that there are other competitive arguments and competitive issues that we have to consider. And I think that's really what separated the two. And of course, that really other competitive one is we have to compete for resources. And we have to compete for acres, and it all depends, a lot of it depends on what soybeans do. Corn prices have likely made a bottom. I think that's that's kind of a no-brainer at this point, in my opinion. The question is how much, what will they do as we go through the spring? I've seen some analysts that say that grain prices are headed downward. Maybe, but it's going to take a heck of a Brazilian soybean crop, in my opinion, to push grain prices much lower. And so I think we've made a bottom. As far as buying feed, you're probably not going to get hurt buying feed, but I wouldn't get too out in front of it. Weekly chart, if we can see, we're back into a trading range that we spent about 1.5 years before last summer in. I think this corn market's going to find that trading range pretty comfortable. If you go back into the 70s, we traded kind of at the top of the trading range then was the bottom of this one. And then we've moved in this one and we stayed there except for the scare of 95 and 96. And now we've moved into another trading range here that looks pretty logical to me that we're going to stay possibly within that. But it's a pretty wide trading range. It's $3 to $4.50. Okay? Staying within those bounds shouldn't be too hard. But the important thing is the bottom of it is $3. And the bottom of it used to be $2. And so we're still going to have to adjust to higher feed prices. Corn has to compete to keep this ratio of soybean to corn low. We got to keep that ratio low in order to get corn acres. Here is the run up in soybean prices relative to corn a year ago that really drove a move away from corn acres. The year before that, here was the ratio that got us all those corn acres to start with. And so we're kind of in the mid range, which I would expect. But I think corn has to compete with soybeans, and that's one of the reasons it's come up. Soybean meal futures, of course, still going up, trending upwards here. And this is being driven right now by what's going on in Brazil and Argentina and some dry conditions in some of the growing areas. It's all going to be a weather market based on what goes on there. What's your feed cost? Well, I've used this measurement for several years. When I started using it, I was using it mainly to measure the variability of feed costs. This is just the corn and soybean meal to make a 16% crude protein diet. And my thinking has always been is this is what drives the changes. The other things at one time, the other things that we put into feed were, number one, a pretty minor part of the feed, and number two, they didn't change in price very much. Well, that changed last year when vitamins and minerals and Dical and some of those kinds of things went out the roof. But still, this is a pretty good measurement of where we are on feed costs. Here's where we were last July, where it peaked out, and this was where the future said we were going. Here's where we were on December 8th, and we've increased that number just a bit. As a matter of fact, it's fallen off here in the last few weeks by a couple of $3, but not very much. But again, we've moved into a new area here in the 140 to 170 range that I think is going to be kind of our new trading range for this feed cost index at about twice the level it used to be. So feed costs have gone up. We're going to have total costs that we have to cover. Monthly profits for 2007, I don't have to tell any of you, it wasn't a very good year. In fact, these are some of the largest monthly losses we've seen in history. November and December were both over $40. The average for the year at $21.54 will make 2008 on the Iowa State estimated costs and returns the second worst year on record, second only to 1998, and actually worse than 1999. So a pretty bad year, no question, on profits for those who bought corn and soybean meal on the spot market and sold hogs on the spot market. I think there were a lot of you did a pretty effective job of managing risk last year and took some high hog prices that were offered by both packer contracts and the futures market and probably did better than this, but still that's what, if you bought on the spot markets, you would have done. The accumulated wealth, and this graph shows how much you'd have in a savings account if you sold one pig per month, according to the Iowa State estimates, and put those profits in the bank at zero interest, which I always tell bankers is about what they pay on savings accounts. And so you'd accumulated about $450 back before 1998. It went to minus 100. We stayed in a pretty bad shape for about 8 years before we got back to even. It peaked out in September of 2007 at $786, and that has now gone down 40%. And when I've talked to bankers that I interact with pretty frequently, they said, yeah, about 40% of their equity gone is about where we stand right now. So a 40% reduction in equity, you had to be in pretty good shape to stand it, but the point is that the staying power of pork producers for the next year is not nearly as good as it was for the last year. And so losses that, should we get in deep loss situations in 2009, we could see a lot more financial turmoil in the pork industry. What's demand doing? Not much. is kind of the answer. It's not a pretty picture. This is domestic pork. Whoops, let's try this again. Pork, chicken, and beef demand index, indexed back to 1985 at 100%. And you can see that pork is down pork was down about 5.6% through November. Beef down 5%, chicken down 2%. All of these have gotten worse as the year has gone along. Probably a reflection of two or three things. The pork demand index is a reflection of what we've done to some degree, of what we've done with exports. And that's a calculation issue. What these indexes are is you basically compute per capita consumption and take the percentage change in that relative to the percentage change in price and compute an index for the change, the shift of a demand line. Well, this year, per capita consumption in the U.S. is down. Why? Because we're exporting right at 20% of our production. And it takes a while for prices to respond. So through our calculations, we show a soft demand index, which, if prices respond eventually, may take care of itself. It hadn't done so yet. But probably the more concerning thing I see here is that all of these are trending downward. Since the big rally of the Atkins diet in 2004 and 2005, meat demand in the United States has really taken a hit. And I have to be thinking that, what's the future hold? Have we seen the apex for meat demand? Have we seen our highest per capita consumption levels? We've speculated for a long time that at some point there was a saturation point for how much meat we could eat. Maybe we found it. And we have to put that into context of the economy, of food service, of how much disposable income we have, of the attention being focused on people like me and the obesity crisis. Okay? There's a lot more of this going on now than there has in the past. And we may have seen the apex for meat demand. If so, we need to think about that as we think about how much meat can we sell at a profitable price in the future. It's a very, very important question, and one that you could put me over hot coals or something, but I don't think I can do a whole lot about predicting it, because we have very poor data for trying to predict demand. We market analysts, we spend most of our time trying to predict supply. And if we can get supply right, historically we were okay because demand didn't move that much. Well, wrong again. It's certainly moving now, and there's very little data that we can use to predict it. An alternative measure of the demand index, and I'm going to show you this one for pork, is real per capita expenditures for pork. And notice, if you look at the blue line here versus the blue line there, they're shaped almost exactly the same. The only difference is that this one is denominated simply in dollars. Okay? It uses the same data. It's almost the same calculation. And so one of the things the Pork Board has been using is they've been looking at just real per capita expenditures. And one of the real advantages is it's much easier to compute on a monthly basis. And this is monthly real per capita expenditures on pork. And you can see very clearly that one of the problems here was last summer. It says that demand was low. Well, I'm here to tell you I think that's really kind of the result of our calculations, because what were we doing in the summertime as far as exports? Huge run-ups in exports that pulled supply out of the U.S. market, and since consumption is the residual of the calculations, production, beginning inventories plus imports plus production minus exports minus ending inventories equals disappearance, which we assume is consumption. Okay? Since exports were growing so large, it looks like consumption was very low. Now, I think it's no accident that the first month since early this year that we've been above a year ago was in November. Because why? Retail prices were finally reacting to this tighter supply of product in the U.S. So I think this is going to get a bit better, but I'm still concerned about the trends that we see in demand. Exports, huge story this year. Still up 53% at the end of November, but notice that November was only up 0.5% from a year ago after these 100% increases last summer. And of course the driver to that was the brown line here, which is China and Hong Kong. Last summer, the question was, well, are they just going to be a customer forever, or what? I've argued since the beginning that China and Hong Kong was a customer of opportunity. They had huge losses of pigs year before last due to blue ear or whatever the disease was they had. They had large losses due to the earthquake. They had a very difficult winter a year and a half ago. They had this little thing called the Olympics this summer. And so all of that added up to a huge push to import pork during the summer months. But they're down 80%, over 80% since the peak back in June as of November. And while China is always going, and Hong Kong could always be important customers, I think it'll be a long time before we see their impact like this again. The good thing is that Japan has continued to be a steady customer for U.S. products. Mexico has recovered from a very bad year in 2007. Russia is growing in spite of the announcement today that they're going to block some shipments from some U.S. plants. I'm not too worried about that. It's 4 plants. They'll get the product somewhere else in the short run. And they have already announced that they're going to double the tariff rate quota for next year for U.S. product. So we still have some good things going on with exports, but can we grow them by 50% again in the next year? I'd say that's pretty doubtful. What have been the impacts? Well, the big impacts of the surge of exports last summer was to pull up the value of low-valued products. This chart is really busy, and I admit that, but I want you to focus on the blue line, 42% chem lean trim, the green line, 72% chem lean trim, and that purple one right there, which is hams. Look what they do as we go through the year, and look where they end up here. They're usually at the bottom of the heap as far as price per pound, and they end up near the top last August due to exports. People stood in and bought low-value product. Now, another one big in this was Russia, because at about the same time they bought all this product, about the same time they announced that they were going to stop imports of chicken for a month. Okay? Well, you got to eat something. And so I'd say that's a good trade, chicken for pork. But anyway, but it really pulled up these low value. This is the closest relationship of the most expensive pork wholesale cut to the least expensive in the history of this data set. It's never been that tight before. And notice that after the China kind of gets out of the market, that same spread comes back. A huge run-up in low-value products. The second one was that exports caused us to have record prices for byproducts. This run-up in byproduct value that you see really started back in 06 and 07. It got started big time in 07 when fat prices started up. But the big push this last summer were things like tongues and stomachs and intestines and bungs and things that I tell people haven't been served at the Meyer household recently. Okay? Huge run-up in those values. Record byproduct values here in the summer of 2008 at $23 per head. But look what's happened as China's exited the market. Exports have slowed down. We've brought these back down to a much more normal kind of $12 or $13. The other point I would make is last summer, even the meat margin, which the purple line here is the difference in the cutout value and the average net cost of pigs in the U.S. was high. In recent weeks, packers have been operating some weeks in the red on meat margin, and it's really had a big impact on packer margins. So how will the stronger U.S. dollar play out against exports? Well, it won't help. I don't think there's any question about that. But I still think we have to keep the dollar in context of where it has been historically. No, it's not down here at 80, 82 cents on this dollar index. It's improved some from there, but it's still historically weak. And with cutbacks in other parts of the world, especially the EU and Canada, even though Canada probably will have more pork to sell on international markets because they're not going to send quite as many hogs to the United States due to country of origin labeling, I think we're still going to be the place where people have to turn to buy pork this year. Do I think we can increase it 50%? No. I don't think there's probably any chance of that. But I think there's a reasonable chance that we can hold our exports together and maybe not break our string of record years. That would be a huge accomplishment, in my opinion. Okay, hog supplies. The December Hogs and Pigs report said we were indeed cutting back. If we look here, here's the actual numbers on a percentage of a year ago basis. This is the pre-report estimates. There's a few of these were major differences. Now, one of them was the breeding herd. The breeding herd was not as small as what analysts thought it would be when the report came out. Down 2.4%, they thought it would be down over 3%, so not as big a reduction there. In addition, the big difference especially was this under 60-pound category, the September-November farrowings and the September-November pig crop. All of those were substantially smaller than what was expected. So why did we end up with this? And these three fit together, but they don't go with a breeding herd that's only down 2.4%, do they? Well, I think the answer is, they might. If we look at sow slaughter patterns last summer, we were killing some piggy sows, Dan, in June and July. And a lot of the sows, or some of the sows that would have farrowed in this September-November quarter, were slaughtered in the summertime. On the other hand, I'd had reports that gilt supplies were pretty tight late in the summer, and it looks as though what we did was slaughter sows when feed was very high priced, and we may have replaced a good portion of them with gilts before December 1st, driving the breeding herd back up and leaving somewhat of a hole here in the September-November supplies as we go forward. I'd tell you this, if you look at the price of weaned pigs during the fall, it says that there wasn't very many of them available, and it coincides with the September-November farrowings. If we look at what we're going to have coming from next year, I think this is going to be an important determinant. Notice also that February, the DSFEB intentions and March-May intentions have gone back up toward year-ago levels. So for now, I think the liquidation of the U.S. sow herd is somewhat over with, at least pending what happens in the coming months. Now, lower hog supplies are on the way. Here's the projections out of that report. The green would be predicted for 2009, and you can see we have a pretty substantial move away from this past year's slaughter numbers indicated by the December Hogs and Pigs report. And I put in adjustments there for fewer hogs coming from Canada as market hogs in the short run, and fewer feeder pigs as we get out into the rest of the year, mainly due to country of origin labeling and the ongoing reduction of the Canadian breeding herd. Here's the market hogs, and of course those went down all during the year. They dropped some when in October 1st when mandatory country of origin labeling started, but they've been going down all during 2008. I think these numbers, I thought they were going practically to zero until USDA released the final rule for MCOOL last week. That rule allows packers to take these pigs and put them in a multi-country label as long as they slaughter some pigs that were born in Canada and fed in the United States. The original interim final rule said that these pigs had to be labeled product of Canada and the U.S., and they were the only pigs that could be labeled that way. Now they can go into a product of U.S. and Canada label as long as during that slaughter day or slaughter shift the packer kills some of these pigs that are fed in the U.S. but born in Canada. So there's a lot more flexibility with these. I still think the numbers are going to be pretty low. I'm saying somewhere around 20,000 a week, probably 10 to 20,000 for the year, but more than what I thought because they have more flexibility in using them. On feeder pig imports, those declined steadily throughout 2008 as well, and I think they're going to stay probably in this 100 to 120,000 range as we go through 2009. I'm one that doesn't think that MCOOL is going to be as big a deal as it was thought to be. And we'll talk more about that right here, I guess. The rules are pretty well understood, at least until the final rule came out last week, and I was going, okay, what fits where? And I had to call Washington because there wasn't a place to put these pigs born and fed in Canada and then mixed in with these others. The rule doesn't cover it. Oh, well, yeah, it does. No, it doesn't. And the guy on the other end, who was one of the higher-ups, said, you're right, it doesn't. So they had to issue an explanation on that. So it's still a little bit fuzzy. The wild card is going to be U.S. consumers' reaction to multi-country labels. Will they think Canada on the label is a problem? I don't think so. We have a pretty positive view of most things Canadian. And so I don't think it's going to be a big deal. Now, beef with Mexico and Uruguay and Paraguay and What's-a-Guay or whatever on that label, I think that could be a problem. So I think this issue is much more severe for the beef industry than for us. But the only way we're going to find this out is go down the road. My expectation is that consumers won't have a big problem with it. I think they're going to ignore it, and when they see it, they're not going to be too worried about it. And if that's the case, then Canadian feeders and weaned pigs will still be wanted here in pretty large numbers, and they'll come here and be used pretty effectively. How many producers it will still be left in Canada is another question, as the exchange rate has moved back in their favor, but they were hurt pretty severely over the last 2 years by both hog prices, corn prices, and the exchange rate. Here's the evidence I was using, saying, that September-November pig crop may certainly have been short because this was a much larger than normal run-up in spot market prices for 10 to 12-pound pigs. The breeding herd reductions, the U.S. down 2.5% here in both September and December. Canada was down 8.3% in October. Their January numbers will be published in about 2 weeks, and I suspect that they're going to say somewhere in the 7 to 8% range as well. If that's the case, that's going to put this combined breeding herd, it's the smallest since 1986 already, and if that is the case, if they're down another 7% when these next numbers come out, it'll be the smallest Canadian-U.S. breeding herd since my data set started back in 1973. So much smaller productive capacity out there, so we're going to have to do some things on productivity. As far as sow slaughter, the purple is slaughter of U.S. sows. Based on this is the number difference from a year before. You can see we were killing a lot more of our own sows. The Canadian slaughter was up until the Canadian buyout program started in the summer, and then has stayed pretty low through the rest of the year. This big swing here was because Thanksgiving fell in a different week. And so you can see the slowdown in U.S. sow slaughter. So, what do I think is going to happen? Last year we ended up commercial slaughter of 116.5 million head, almost 8% larger than in 2007. A lot of that is attributable to the success of circovirus vaccines. I mean, we just got a lot more pigs to market than we did before. Going into this year, this is my forecast over here on the right, and then that for the Livestock Marketing Information Center, Iowa State, and the University of Missouri. I think slaughter is going to be down about 3% when we get to the end of the year, with the major reduction of that in the second quarter based on what the December Hogs and Pigs report said. I noticed that my numbers in Missouri's are pretty close to each other. The LMIC is kind of right there with us, even though a much more even kind of reduction. I haven't seen John since he came out with these. I was going to accuse him of doing chicken forecasting here, just a straight line. But still, we still come up with similar numbers for total slaughter for this year, down about 2 or 3% for the year. I've got 3.2% down for the year. When we look at prices, we all try to forecast a different price series to make sure we confuse you sufficiently. But I did put in the historical prices here so you can see the differences. I've got hogs in the upper 50s, low 60s here in the first quarter. Obviously, they're going to have to hustle a little bit on that. I think we're going to trade some hogs in the 80s as we go through the late second quarter and into the third quarter, and then some pressure again in the fourth. So a pretty good second and third quarter. I put these numbers in green since I cheated last week and revised my forecast since these other guys have. So they're at a bit of a disadvantage here, or relative to my revisions. Here's the futures prices as of yesterday. We all find ourselves in the very unusual circumstance of having forecasts that are above the futures market. That hasn't happened in a long time. And it makes me a bit uncomfortable because I tend to put a lot of stock into the futures prices. They're real people betting real money about what those prices are going to be, and so that brings some reality to the situation. But I still think that we're going to trade these markets up. I believe the futures prices are getting mashed down by some general negative market psychology with the whole economy situation. I really believe there's some pressure there that's probably not based on fundamental analysis of the hog business. Now, the problem with that is it's not offering you any opportunities. The last 2 or 3 years, that market has been, in my opinion, biased upward by funds, by long speculation, by whatever, but it's been very high, and it's offered a lot of great pricing opportunities, and many of you have taken advantage of it. Good for you. Unfortunately, it's not right now. And so my advice to the producer clients that I work with has been to sit back and wait. We normally get a seasonal rally, and I've got a slide here. Let's go to it right here. This is July, and this is June and July hogs. And normally in January, you've seen about half of the typical seasonal increase that starts back in the fall and goes all the way into the first part of May. And so I've been telling folks, don't get in too big a hurry to sell those summer hogs and maybe even the rest of the year, because historically, this is a very predictable seasonal pattern that peaks in early May, and I think we ought to probably wait for that and see what happens. These are not bad hog prices out into the future. This is 2009. These would be the Iowa, Minnesota prices implied by those futures markets. And we're talking $60, $70 carcass prices. Not bad at all. But with costs up in the $60s and $70, they're still not enough to put much black ink on your operating statements. So here's the relationship between forecast costs, somewhere in around $70 per hundredweight carcass. This is using the Iowa State University production parameters that are in their estimates, and then Iowa, Southern Minnesota prices as implied by the futures markets. And you can see there that only a few months of profits during the summer months. So, my price expectations. First, retail prices, in my opinion, are headed up. And they're going to be headed up and led by chicken. Now, they have not been led by chicken so far. This is monthly USDA estimated retail prices, and you can see that beef and pork reached record levels here earlier this year, last fall. They both dropped off here as we went through the wintertime, but notice that chicken has just started up as the cutbacks that I talked about early in the presentation have started to take hold. Those are going to get larger, and as they do, that's good for pork. Pork Board funded research says that those are the two real close competitors. We're closer competitor with chicken than we are with beef in the retail meat case. So as chicken prices go up, it should help pork prices as we go through 2009. So that's good. Hog prices, a poor first quarter, a poor fourth quarter, pretty good in the second and third quarter. Again, that is not as good as it was just a month ago. And I think it will get better as we go through this year, so I'm not advising that people start booking much as far as hog prices as we go forward. More breeding herd reduction, I don't think that's going to happen given the economics we have right now. This isn't bad enough to get liquidation, but it's certainly not good enough to get any kind of expansion. Canada is probably still going to make some cutbacks as we go through 2009. Our weights will be constant to growing slightly. Average market weights last year were actually below the year ago. That doesn't happen very often either. Notice I've said that several times in this presentation. We're in kind of unprecedented times. Productivity will increase sharply. We've had 2.5% increases in litter rates in the last 3 quarterly reports. Those are big, big increases. And I think they're going to start. I noticed, Dale, the cover of National Hog Farmer, 30 pigs per sow per year. I mean, we're going to see that number in pretty short order, I think, on some very well-managed farms. Will the cutback be enough to keep the industry profitable? That's the question. We have not reduced supplies very much. 3.2% is a pretty small reduction in slaughter for the coming year, and if we grow carcass weights a bit, production will not be back down that much. So, the risks, the biggest one in my mind is demand. We've seen a lot of trouble in the restaurant business, and that's the one that gets hit first. We're not as exposed there as our chicken and beef, and I think that's the source, one of the real sources of beef's problems in trying to price their product this fall, is even on tighter supplies, they haven't been able to push their prices up because of what's going on in the restaurant business. But I think this is going to be a big thing both on the domestic and international side, and it's the biggest risk we face going through 2009. Exports, declining growth is a virtual certainty, but will they actually decline? People who say yes would point to Mexico and say, You know, a 15-20% devaluation of the peso is terrible here, and it is because it's a very price-sensitive market to start with. But on the other hand, would say, well, Europe's cutting back, Brazil isn't growing very much. Where else is somebody going to buy pork? And if chicken production falls, then pork could substitute for some of that chicken in exports. The wild card is China. I mean, they drove what happened this last year, and there is the question of whether they can drive that again this year. Productivity growth may outstrip our breeding herd and breeding flock reductions. I didn't point it out a while ago, but if you recall the graph about the broiler breeding flock, the number of hens, and it had been flat for about 10 years. During that 10-year period, though, chicken production went up 26%. So they've been doing the same kinds of things you have from the terms of productivity and getting more out of a constant or falling breeding flock. A new round of cost increases in 2009. You know, when we get into the spring, I think all bets are off. You know, what happens to the crop in South America? What happens to our weather? What will happen as far as bidding? We're still. The January revision of the corn supply and utilization table says that we now have a projected carryout of 1.7 billion bushels. That's a relatively big number, but it's still a relatively small percentage of this usage base that we've built. And remember, I haven't even talked about the renewable fuel standard today. That's one of my favorite subjects. It goes up. It went up from 9 billion gallons last year to 10.5 this year. So we have to use 500 million bushels more corn to make ethanol by the requirements of the renewable fuel standard this year. So that has to come as well. I'm still concerned that USDA has the feed number in that corn usage table too low. It's down about 8-9% from a year ago, and I don't see any of these species cutting back anywhere near that much. So it's kind of hard to take care of that. And there's not going to be enough more DDGs to make up the difference in the calculations. Finally, what are going to be the MCOOL impacts? You've heard me say I'm not sure they're going to be great, but there is going to be some impact at least until April, when USDA officially starts enforcing MCOOL, and to see what the reaction of consumers are going to be. Until we kind of find out how consumers are going to react, there could be some impacts. But I think in the long run it's going to come out to be not a big deal for pork. Much larger deal for cattle than for pork, but only time is going to tell. Finally, two things that I write, for those of you who aren't familiar with it. First, Dale mentioned weekly North American preview for National Hog Farmer, and a daily livestock report for the Chicago Mercantile Exchange that Lynn Steiner and his group and I write. You can subscribe to those free at these websites. We'd love for you to give them a chance, and they won't take very long to read. And hopefully, since they're both free, we hope they bring you more value than they cost you.